The financial crisis of 1791 was the first stock market crash ever experienced by the businessmen and investors of the US. But guess what? This was the same crash that produced some of the wealthiest people of that time. Similarly, Black Monday, also known as the crisis of 1987, is known to the world as the largest one-day stock market decline in history. That was not all as the devil for all but angel for some, after periodic emergence re-emerged during the COVID era and the stock prices plunged to an all-time low. Now you might be thinking that stock market crashes are the worst happenings for investors, but what if we tell you that this crash brings an opportunity that we all fail to recognize? And after all, this is the reason why the rich are getting richer and the poor are at the helm of poverty. In this video, we're going to be providing a guide to understanding a stock market crash and how a value investor can make the most out of it. There is a common perception that a market crash brings inflation and recession in the prices of stocks, what we know as the bear market. And truth be told, it is appalling how the great majority of investing pundits make us believe in the fact that the stock market crashes are something to be afraid of. This video is going to provide a historic account of stock market crashes and the difference between inflation and recession, which will help people have a firm grip on investing strategies during a crash. So sit back because you don't want to miss out on this. Welcome to 5-Star Finance, the place where we teach you how to achieve financial freedom. Most people confuse a market recession with a market crash, and they fail to understand why a market recession is important. But rest assured, because by the end of this video, you're going to have a completely different opinion about investing during a market crash. To begin with, a market crash is the best time to chase your next digit because, as we saw during the COVID pandemic, the government printed millions or even trillions of dollars at that time, and the money was sent home. This helped millionaires to jump into that billionaire lane, and similarly 10K turned into 100K for most people. Now, a recession is something of a temporary period when trade and industrial activity are reduced, ultimately resulting in an economic decline. A recession can be identified by the fall of GDP in 2 successive quarters. So if the GDP keeps on receding for 3 to 4 months at the start of a fiscal year, and it keeps on receding during the next 3 months, then it should be understood that we're undergoing a recession. So if any pundit says that we're officially in a recession, make sure you do your research before acting. But a stock market crash is something different. A stock market crash is something that revolves around a dramatic decline of stock prices across a major cross-section of the stock market, which usually results in a significant loss of paper wealth. Now, one of the biggest reasons for a stock market crash is the looming economic factors, which cause the panic selling of stocks. For example, after the war era, one of the most significant crashes was experienced in the 1930s due to the widespread turmoil caused by the war. So what happens during a market recession is that companies go out of business. This results in employees losing their jobs, and consequently, borrowing money becomes a lot harder. All of this leads to the stock market going down. It all comes down to one thing. When you're standing in the middle of a forest, it might be all sunny outside, but a forest is a dark place from the inside, right? So who's getting all the sun? Who's getting the attention of all the sun? The taller trees. You're not getting any water. You're not prone to any rain. So it is like the big companies, the tall trees, are getting all those funds, those reliefs in the form of reduced taxes, those economic bailouts, and everything. It is very hard for the new younger trees to grow up because the taller trees will usually outperform or simply buy them. Now, a market crash is something like a forest fire, which happens naturally. Forest fires go through a natural forest fire after 5 to 10 years. Similarly, the economic cycles can flourish at their best for 5 years, and in the most recent development, something like 10 years is also achievable. So very quickly, the forest fire makes all those tall trees look like a scene from the movie San Andreas, and that is when the small trees, young value investors, get to make their call. So why is a forest fire, or a market recession, actually a good thing? To put it all straight, during a recession, all the bad companies go out of business. So this provides some room for new companies to grow. It starts a decade or so of growth, and it cripples that overpriced talent. That also means that all those stocks which were overpriced before the recession are going to be underpriced now. A recession also provides gateways for new talents to flourish. The talent previously uncared for will find it easy to pave its way to top-notch companies, as now they're looking for new employees. When we look at the historical landscape of all these market crashes, we find a trend that can be a lot more helpful to make some decisions. For example, the market crash which took place due to the COVID pandemic lasted from February 19, 2020 to March 23, 2020, during which the market dropped more than 34% and its duration was 33 days. Similarly, the market crash, which is also known as the computer trading crash, lasted from August 25, 1987 to October 19, 1987. And during this tenure, the market dropped 36.1% and its duration was less than 2 months. This was followed by the dot-com bubble plus the 9/11 crash, which lasted from March 10, 2000 to October 2, 2002, during which the market dropped 36%, and the duration was probably more than 2 years. Similarly, there are various other market crashes like the post-World War II crash and the Panic of 1907, the continuation of the Great Depression in the early 30s. But the recession of 2007 was something that found everyone off guard. The market drop was more than 54% and its duration was 17 months. Now, some of you guys are too young to say, "Who's the Lehman Brothers?" While some of you guys, who are more than 40 years old, will know that they were the big deal at that time. But due to the recession, they ran out of business. Similarly, Countrywide also ran out of business along with other top companies. Now, these companies are no small deal because most of them were more than $300 billion businesses. They simply vanished. At the top of the list of crashes is the recession you all guessed about. It was the Great Depression of 1929, which lasted for 34 months with a market drop of 89%. But something's going to happen here. Now, the part that we have to look at is that a lot of times we look at these crashes with the pessimist thought of a scared mouse in a hole. We're not scaring you, but we're just telling you how you can perform in the best way during these crashes. So the next big question is, how do we prepare for a market crash? So first of all, talking about defense, you can fly to safety. When there is real turbulence in the markets, most investors usually tend to move towards cash or equivalents. But according to Warren Buffett, bear markets are something when you can buy stocks for a lesser price. So if you can anticipate a crash, you can always have some income to get your hands on some cheap stocks which can boom as the market gets back to stability. Risk for you should not be about volatility. It should be about losing the money in principle. You can come out a lot stronger if you can define your risk tolerance. It is during the market crash that the lazy, arrogant, and over-leveraged will be filtered out. The stock market crashes are danger zones for some investors, but at the same time, it is an opportunity for other investors. Some people tend to stay out of this game of swords, while others tend to jump in where the battle is thickest, and usually they're the people with the clearest understanding of stocks as they achieve profits. For that reason, understanding stocks should be the core principle around which your investing strategies should be centered. We provided a free ebook in the link given below, which will explain the 6 stock categories which are very important for every investor to learn. Check out the video we handpicked for you, and we'll see you in the next one.